Welcome to this video on calendar time portfolios. In the previous video we talked about how calendar time portfolios work, and in this video we will look at an application of calendar time portfolios. More precisely, we will replicate the Andrew Ng et al. Paper on the idiosyncratic volatility puzzle. Before we start, let me briefly introduce myself. I'm Alexander Hillert. I'm a professor of finance and data science at the Leibniz Institute for Financial Research, SAFE, and at Goethe University Frankfurt. So in this video, I would like to take just a moment to tell you what the idiosyncratic volatility puzzle is. Then we will switch to Stata, where I take you step by step through my replication of the Andrew Ng et al. Paper. Then we will compare our replication results with the results of the original paper. And we will conclude with an out-of-sample test where we look at whether there is still an idiosyncratic volatility puzzle in the sample period or after the end of the sample period of the Andrew Ng et al. Paper. So let's get started. What would we expect about the relation between idiosyncratic volatility and the cross-section of stock returns? As you probably all know, idiosyncratic volatility can be eliminated by diversification. So if you have many different stocks from firms from different industries, different countries in your portfolio, you have a well-diversified portfolio. And that means that if there is a negative idiosyncratic shock to, let's say, company 1 in your portfolio, there's a good chance that another company in your portfolio will have a positive shock, positive idiosyncratic shock. And then these shocks cancel out on average, and you are just left with systematic risk. And as investors are assumed to be rational in traditional finance, the capital asset pricing model assumes that investors understand this logic, have well-diversified portfolios, and all they care about is systematic risk. And that's why in the CAPM, the capital asset pricing model, expected returns are only related to a firm's beta, so it's systematic risk, but they are unrelated to idiosyncratic risk. And therefore, what we would expect if we sort stocks based on idiosyncratic volatility, on the slides, by the way, I abbreviate that with IVol. So if we do a sorting exercise on IVol, we expect to see no difference in the average risk-adjusted return of the high IVol portfolio and of the low IVol portfolio. And here we would take the average return of a portfolio as an estimate for the expected returns. And in terms of sorting, we follow the typical logic. At the end of our formation period, we would measure IVol, and then we would look at future returns, and we would expect not to see any relation between idiosyncratic volatility and future returns. However, there is empirical research, and most importantly, this well-cited paper by Andrew Ng and co-authors, where they analyze the idiosyncratic volatility return relation using calendar time portfolios. So more precisely, what they do is they first need to measure idiosyncratic volatility. And here they decide that for each stock and each month, so like January 2000, February 2000, March 2000, and for each stock from 1 to n, you would run a regression where you regress the daily stock excess returns. Excess means here above the risk-free rate. So you take these daily excess returns and regress it on the factors in the Pharma French 1993 three-factor model. That is, you regress it on the market excess return, the small minus big factor, and the high minus low factor. And then what the regression will give you is an alpha and 3 beta coefficients. And then with that, you can determine the epsilon for each observation. That is the difference between the actual stock return of stock I on day t and the expected return for stock I on day t given the factor realizations. When you have these epsilons for all days within a stock month, what you then can do is you take the standard deviation of these epsilons, of these regression residuals. And this is a measure of how much the idiosyncratic shocks of a stock vary. So you can think of the epsilons as idiosyncratic shocks. If you have like positive epsilon, the stock performed better than expected by the factor realizations. If you have a negative residual, that would indicate on that day the stock had a negative idiosyncratic shock, it performed more poorly than expected. And by taking the standard deviation of this residual, we get an idea whether a stock has a lot of firm-specific risk, meaning these epsilons vary a lot, or whether a firm has little idiosyncratic risk. Now, if we have for each stock and each month, we have computed idiosyncratic volatility, we can form monthly portfolios. That is, at the end of each month, we form, in the case of Andrew Ng and co-authors, 5 quintile portfolios based on the IVol that we just estimated. We keep these portfolios for 1 month, so buy the high IVol portfolio, sell short the low IVol portfolio, and we take value-weighted portfolios. So both within the high IVol and the low IVol portfolio, we will weight stocks by their market capitalization. In terms of sample period, Andrew Ng and co-authors start in July 1963. That is when, in addition to the NYSE stocks, the stocks at the American Stock Exchange become available in the stock market. Data from CRSP, from the Center for Research in Security Prices. The sample period ends in December 2000. So we have a relatively long sample period and should get an idea of what the relation between idiosyncratic volatility and average returns is. So what do Ng and co-authors find? Well, here you have their main result. It's panel B of table 6 in their paper. Rank is the IVol quintile portfolio. So 1 would be the 20% of stocks with the lowest idiosyncratic volatility. 5 will be the portfolio with the 20% of stocks with the highest idiosyncratic volatility. And we see the average monthly return in the holding period expressed as a percentage. So 1.04 is 104 basis points, so 1.04% is the average monthly return of the low IVol portfolio. In contrast, the quintile 5 portfolio, the high IVol portfolio, earns a negative return of minus 2 basis points or 0.02%. That means if we look at the difference between the high IVol and the low IVol portfolio, we have minus 2 basis points, minus 104 basis points, and that brings us to minus 106 basis points. If we perform a statistical test to see whether this 106 basis points is significantly different from 0, we get a t-set of minus 3.1, indicating we can reject the null hypothesis that these returns are 0 at the 1% significance level. So here we would conclude it seems that the high IVol stocks significantly underperform the low IVol stocks, measured by raw returns. When we perform a risk adjustment to control for potential differences in systematic risk, we see that the difference in the 5-1 portfolios gets even larger in absolute terms. So when measured by the CAPM, where we control for the systematic risk of the stocks in our 5 IVol portfolios, we find an underperformance of minus 138 basis points per month. So it's about 32 basis points larger than the performance in raw returns. Does that result make sense? Well, idiosyncratic volatility and systematic risk beta are empirically positive correlated, meaning that the firms in quintile portfolio 5 tend to have larger betas, tend to have more systematic risk than the firms in portfolio 1 that have rather low betas and little systematic risk. And as a consequence, the stocks in portfolio 5 need to earn higher raw returns to compensate investors for the higher systematic risk, but empirically they don't, and this is why this underperformance becomes even more severe when we control for the systematic risk of the high IVol stocks. And the results do not really change when we take the Farmer Friend 3-factor model. We still get an alpha of minus 130%. The last thing that I would like to briefly talk about is this column standard deviation, and that's the variation of portfolio returns over time. Remember, the sample period is from 63 to 2000, and for each month we get a realized return for each of the 5 IVol portfolios. And the standard deviation here is how much the returns vary over time. And we see that the portfolio where we have the high IVol stocks, that it has a much higher volatility than the portfolio with the low IVol stocks. So to conclude, we see there is a strong negative relation between idiosyncratic risk and future stock returns in the cross-section. And this is a puzzle because, as we just talked about, based on the CAPM, we would expect to see no relation. So we would expect that the return for our quintile portfolio 1 is as high or as low as the return of our quintile portfolio 5. So in the next part of our video, I would like to take you through a replication of the Andrew Ng paper in Stata. How does it work? Well, I will switch from my PowerPoint slides to a Stata do file. That is the code that you write in Stata. The code will be available on the Safe Data Center webpage, so you can download my do file and run the code on your computer to see whether you arrive at the same results. To be able to execute the code, you not only need my do file, but you also need the underlying data set. And for copyright reasons, I cannot provide you with the stock market data from the Center for Research in Security Prices. That is why at your university or at your research institution, you need to have access to the CRSP stock market database to be able to run the code. But if you have that, you will be able to execute the code and should arrive at exactly the same replication results that I got. More precisely, in this video here, we will only focus on the calendar time portfolio sort part of the replication. So my replication is split in 2 parts. The first one deals with estimating idiosyncratic volatility. The second one deals with taking the idiosyncratic volatilities that we computed and performing a calendar time portfolio sorting exercise with that. And in this video, it's just about the second part. So we take the IVol from part 1 as given and just work with that to get calendar time portfolios. Okay, then let's switch to Stata. So here we go. You should see my Stata do file. The idea here is that we would like to replicate table 6 of the Andrew Ng and co-authors paper. And at the end, we would like to run a little robustness check where we look at what is the relation between idiosyncratic volatility and stock returns after the end of the sample period from Ng and co-authors. The general structure of this do file is that we will open the monthly stock file from the Center for Research in Security Prices and merge it with the idiosyncratic volatility data from part 1 of the replication. Like I said, this is part 2 where we just focus on portfolio sorts. We do not deal with how do you estimate the idiosyncratic volatility. You will learn that in a different video. Here we just focusing on the portfolio sorts. After the merge, we can sort stocks into 5 quintile portfolios. Then we will compute value-weighted portfolio returns. For completeness, I also have equal-weighted portfolio returns in here. Then we will merge it with the Farmer Friend 3 factors, monthly factors, to be able to do the same risk adjustment as Eng and co-authors did. And with that, we have all the data that we need to be able to compute average portfolio returns and alphas. Okay, then let's get started. These are just two standard commands here. In case we have some data set loaded to Stata, we remove it from the memory. SetMoreOff is just a setting that prevents the code from stopping when our output window is full, and then we can adjust the data to the folder in which we stored it on our computer. So you will have to change that when you would like to run the code. The first step is that we just open the monthly CRSP stock market data. So let's do that. And then we can switch to Stata, see that our code has been executed. And then we can take a look at the data editor, where we have the perm, that's the security identification number from CRSP. We have the date, it's monthly data, so it's always the last trading day of the month. We have information on what type of securities that is. We have information on which exchange the stock is listed at. We have a delisting return in case that a stock disappeared, like in this example here. Then we have the stock price, we have the return, and we have information on the shares outstanding. We will need prices and information on shares outstanding to be able to compute the market cap to get value-weighted portfolios. Of course, we need returns to assess the performance, and the exchange code and share code will be used to filter out the relevant securities. Okay, with that, I think we are good to go. So the first thing, that's just my personal preference. I think until 1 or 2 years ago, when you downloaded data from the Center for Research in Security Prices in Stata format, all variable names were lowercase. That means many of my program codes are still assume that variable names are lowercase. And personally, I also like that a bit more. And therefore, I simply rename all my variables from uppercase to lowercase. Of course, you don't have to do that. In the next step, I would like to have a monthly ID in our data set that increases for each year month by 1 unit. Later on, if we want to form a panel data set to be able to compute lead or lagged variables, it is helpful to have numerical date variables that is on the monthly frequency. And here Stata has a function MOFD, which just assumes that the January 1960 is month 0, February 1960 is month 1, December 1959 is month -1. So it increases like always by 1 unit. I can also show that to you, and this variable will be helpful later on for working with panel data. You see here that each month it increases exactly by 1 unit. Here we are like at a new company. If you don't like the way it is displayed, what you can do is you can say format your month ID %TM, and then it's formatted in a way that it is easier for us to understand, like December 1985, January 1986, so on and so forth. But computationally, it's still this variable 300 something that you saw earlier. So you can simply add one or subtract one to go to the subsequent or go to the previous month, respectively. Then we only want to focus on ordinary US shares, meaning common stock of publicly listed US companies. We don't care about international companies. We don't care about real estate investment trusts. We don't care about ADRs or closed-end funds. And therefore, we simply say, okay, the share code of our security must be either 10 or 11. And this is the definition of ordinary US stocks. And we do that because Andrew Ng and co-authors do the same. And that's also a typical filter that we have in empirical asset pricing. In terms of which stocks are we looking at, we look at the three major US stock exchanges, the New York Stock Exchange, the American Stock Exchange, and the Nasdaq. We do not want to have stocks from the Boston Stock Exchange or from the Toronto Stock Exchange. So again, we keep stocks only if they are at the New York Stock Exchange, meaning exchange code equals 1, at the American Stock Exchange, exchange code equals 2, or if they are at the Nasdaq, exchange code equals 3. So run this part. And then what we could do, and what is often done in empirical asset pricing, is that we impose some filters. For example, we often it is argued that it's known that the very small stocks, the micro-cap stocks, that they can be easily mispriced. However, they are hard to trade, and after transaction costs, it's probably no longer, if you have a trading strategy, it's probably no longer profitable to run your trading strategy in this universe of illiquid micro-cap stocks. And therefore, they are in the empirical asset pricing research literature, some filters to exclude these stocks have been developed. So for example, it is common to exclude penny stocks, or some impose a more rigorous filter saying the stock price must be at least $5. And then there are two filters based on the size of the firm, like excluding firms that are in the first NYSE size decile, meaning you sort all stocks at the New York Stock Exchange in 10 deciles, and then you assign the Amex and Nasdaq stocks based on the NYSE breakpoints, and then you say, okay, everything that is below the 10th NYSE size percentile, meaning all stocks in the first size decile, they are removed from the sample because they are so super small, so costly to trade, that it does not make sense to include them in an analysis if you want to get a realistic picture. Alternatively, or additionally, you could also argue that these stocks are economically not really important. Or you could impose a more strict filter saying not only the first size decile should go out, but the first two. Andrew Ng and co-authors, they don't have any filter here, so therefore we also don't filter our data further. Okay, then just to show you how you could form a panel data set, I have these commands here where you sort stocks first by their stock ID, the perm no, and the time ID. So you sort within each stock by time, and then this xtset command tells data, okay, the first variable here, perm no, is the identifier in the cross section. X stands for like cross section, and the second one, month ID, the T here stands for time. And this gives you the option to use lead or lag variables. We will use that a bit later. Now we come to the output of our first part of the replication. That is not part of this video here. Here we use a data set where we have the idiosyncratic volatility of all stocks. Let me quickly show you how this data looks like. So we could say use this data set here. Don't forget to have a clear to get the data that we currently have in the memory out. Here you see the structure we have for each security and each month, a measure of total volatility and a measure of idiosyncratic volatility. For the replication, we will use this measure. In case you would like to replicate the panel A of table 6 of the Andrew Ng and co-authors paper, you can use total volatility instead of idiosyncratic volatility. There are some months where both variables are missing value. That could be because we don't have had a sufficient number of trading days in that month to estimate idiosyncratic volatility. For example, because the stock disappeared. You see that this is the last month that the stock exists here, and therefore it's quite likely that and then by construction, the stock will not be available at the end of the month, and we will not have a valid idiosyncratic volatility observation. But you see that for most months, we have non-missing information on volatility and idiosyncratic volatility. Okay, then I need to go back to my original code, and luckily this code does not take too much time to run. So here we see already the merge result. So if we combine our CRSP monthly dataset with the IVol dataset, and what has happened is that we now have additional columns here, volatility and idiosyncratic volatility, in addition to our original columns. So what comes next? Next we say, okay, if we have no idiosyncratic volatility information, just returns, or the opposite, that we have some observation in our idiosyncratic volatility data set, but not in our monthly main data set here, we cannot really use this observation. So we keep only the observations that have merge equal 3, meaning they appear in both the master data set, which is our monthly stock market data, and also in the using data set, which is the idiosyncratic volatility, which comes from the daily CRSP stock file. So these 24,000 observations that cannot be merged are gone. Now, to make it as convenient for you to change the measure you would like to sort on, be it idiosyncratic volatility or total volatility, I create here a local variable, and then this local variable will be used in the remainder of the code, and you could simply comment in or comment out whatever variable you would like to use. So here we are interested in our idiosyncratic volatility, and we will keep only the firm, the month, and the idiosyncratic volatility of the firm. All other variables are no longer needed for the portfolio assignment. Of course, when it comes to measuring portfolio returns, we will need returns again, but here we just care about the assignment. Okay, so what do we need to do then? Well, we need to form the portfolio assignment breakpoints. We want to have quintile portfolios, so we need the 20th percentile of the IVol distribution, the 40th percentile, the 60th percentile, and the 80th percentile. And we need to do that for each month. Like for each month, we sort stocks in the cross-section based on idiosyncratic volatility. And then we determine what is the 20th percentile. So you see here, the I from the loop goes here. So we determine P20, the 20th percent. Then we increase I by 20. We determine the 40th percentile, the 60th percentile, and finally the 80th percentile. And then we do the portfolio assignment. We say, okay, we create an empty variable, and then we assign a stock to IVol quintile 1 if the stock's IVol is smaller than the 20th percentile of the IVol distribution. IVol must not be a missing value. If we have a missing value, it means we don't know what the idiosyncratic volatility of a stock is, therefore we cannot assign it. And also the IVol percentile must not be missing. If we don't know like what the breakpoint is, then we cannot do a meaningful assignment. We assign a stock to the second quintile if the IVol is at least the 20th IVol percentile, but at the same time the IVol must be smaller than the 40th percentile. Again, IVol must not be missing and the breakpoint must not be missing. We do the same for the third, fourth, and fifth quintile. And then let me run the code up to this point. This takes just a few seconds for the code to complete. What we will do as a robustness test, we will tabulate, tab is the abbreviation for tabulate, our IVol quintile. And of course, quintile portfolio should mean we have 20% of observations in each of the portfolios, and you see that this is the case. There's a small difference here, and that's because here we have a smaller sign for quintile 1, and here we have a smaller equal sign only for the largest one. So for each month, like one stock, remember this sort is done monthly, one additional stock could end up here, and we have a number of months because here our data goes from 1926 to 2023. So we have almost 100 years, and of course we have 12 months per year, meaning that we have 1,200 months in our data set, and if each month just one observations goes into the upper quintiles instead of quintile 1, that can already lead to this little unbalance that we have. But overall, this is just a very tiny unbalance with 19.99% versus 20.01%. So we conclude this like plausibility check is fine, and then we remove our IVol cutoff, so we no longer need to know what was against the 20th, 40th, 60th percentile, and we keep only the relevant variables. In this case, it means that we see for each stock and each month in which quintile is a stock in. So the stock with the perm node, the security identifier 13717, ends up in the high IVol group, while the stock with the identifier 12394 ends up in the low IVol group in this month here. Remember, in the when we form calendar time portfolios, we have the holding period and the formation period. We are at the end of the formation period and now would like to know what is next month's return. So we need to figure out 1 month later what return did a stock earn. How do we do that? Well, we can simply increase our monthly date variable by 1 unit. Remember, each year month this increases by 1 unit. So if we have, let's say, the portfolio assignment from January 2000, adding +1 means we move our data to February 2000, and then we can merge our data with the return data to see how did the stock perform in February, or more generally, how did all the stocks within a portfolio perform on average. So let's do that, and let's move our data 1 month into the future and then save our data set. Okay, perfect. The data set has been saved and we can continue. Now we reopen our original CRSP monthly data set. Like I said before, I prefer lowercase variables, so we make all variables lowercase, and this time we have a few more variables that we need because we also need like returns, stock prices, and information on the shares outstanding. And then we need to account for extended missing values. So this is a Stata specific thing, and Stata has not just the dot as an indicator that there is no information, but it has also .A, .B, .C, and so on. And the idea is that these indicators should give you a bit of a reason for why the information is missing. So it could be like, okay, it's the first month of a stock is available, therefore we don't have a closing price at the end of the previous month, therefore we cannot compute a return. And in this case, we will put, let's say, .C as an indicator for there is no information available because it's the first month a stock is listed. And for later on in the code, to make sure that if we want to condition on something must not be a missing value, to be able to write dot without paying attention to like what letter might be after the dot, we will set simply all extended values to the standard missing value. So for each letter that there could potentially be, we replace our extended missing value, so dot letter, by the standard missing value, just a dot. So let me simply start this code here, and I can stop it here. You see, for example, for A, the command replace delisting return equals dot if delisting return is dot A resulted in 9,408 changes. Then for dot B, there were 65,000 changes in the return variable. The same for dot C, like dot D, dot E, dot F, that all does not exist here. We have a few more cases like dot T or dot S. Now we have like a unified way of coding missing information, so we can move on again, create a monthly date variable, same idea as before. Each year month the variable should increase by 1 unit, and later on, if we want to say, okay, analyze the period from year equals 1993 to year equals 2000, it might be easier to just have a year variable and not just a month year variable. So we can perform these two operations. Then we come to delisting returns. What is the idea of delisting returns? Return captures only the change in value of a stock as long as the stock is listed at an exchange. As soon as a stock is delisted from an exchange, the stock will no longer be, or the performance of the stock will no longer be recorded in CRSP and in the return variable. Instead, what CRSP will do is it will compute, if there's a final distribution, the change in value from the last closing price relative to the final distribution, and puts this information in a delisting return. So let's say a stock is delisted at a price of $1 and the firm filed for bankruptcy, and a few months later the investors got a 50-cent final distribution. Then you would have a further decline in value from $1 to 50 cents. And to capture comprehensively what is the performance of investing in a stock, we need to take into account this delisting performance. So let's assume we would have bought this stock where the firm filed for bankruptcy. It's no longer at the exchange. We cannot trade it, so we would have to wait until we get the 50-cent delisting distribution, and should take the performance, so this further decline in value, into account to get a realistic and complete picture of the performance of the stock, or how the stock contributes with its performance to our overall portfolio performance. How do we take the delisting return into account? Well, if we have both a return and a delisting return, we compound the two returns and then subtract one to get again to a net return. We only do that if we have a non-missing delisting return. If we don't have a return information, so if return is missing but delisting return is not missing, we replace the return by the delisting return. Then again, we form a panel, same logic as before. We determine set the identifier in the cross section, the X, set the identifier in the time series, the T, and then we can compute the firm's market cap. So we take the price and multiply it with the shares outstanding. PRC is a share price, Shroud is the number of shares outstanding. Market cap is often measured in million, shares outstanding is in thousands, so to get from $1,000 to $1 million, we divide by 1,000. What about the absolute value here, ABS? When there is no trading on the last trading day of a month, there will be no closing price. And in this case, what CRSP does is it takes the average of the bid and the ask quote. To make clear that this bid-ask average and not an actual closing price, CRSP will put a minus sign in front of it. So let's say if your ask is $5.10, your bid is $4.90, the bid-ask average will be exactly $5. However, CRSP would put minus $5 into the database to show, okay, the closing price was not $5, there was no trading, instead $5 is the bid-ask average. Of course, market cap needs to be positive, and therefore we take the absolute value of that. And remember, market cap is measured always at the end of the month we are in. So if we compute market cap for February, what we will get is the market cap at the end of February. However, when we want to compute a value-weighted return, so let's say we invest in different stocks at the beginning of February, what matters is the market cap on the first trading day of February, which is, or at the opening of the first day of February, which is proxied by the market cap at the end of January. So we need like a 1 month lag to get value-weighted returns for our portfolio. And how do we do that? Well, we say L1 is the lag operator, and that only works if you define a panel before L1 of our variable market cap. And this gives us the market cap at the end of the previous month. Let me just run this code. Oh, I already defined month ID, and I probably already defined year. So just do the delisting adjustment and the computation of market cap. Okay, perfect. And we can do a quick check here. Did this lag operation work? Well, here at the end of February, we have a market cap of 11,960,000, and our leg 1 is the market cap from the month before, which is 16.1 million. And we write this last month value here, and then if we want to compute value-weighted portfolios, we can combine this market cap here with the return to get the development. So at the beginning of the month, we would invest 16 million. That's the market cap at the end of January, or equivalently on the first trading day, invest that and would earn throughout February a return of minus 25%. And then we would be left at the end of February with a $12 or 12 million in the stock, and no longer have the 16 million. Okay. Then we again keep only the relevant variables here and save our data set. Since there is just one thing that we need to do, we need to combine our return data sets that we just created with the portfolio assignment information, merge the two, keep only observations for which we have return data, and the return data here is for the holding period, and the portfolio assignment data is from the end of the formation period. We can only look at stocks where we have a valid portfolio assignment and valid return data. And this is why we again keep only the stocks that have a merge equal to 3, meaning the stock was assigned at the end of the formation period, and we have also information in the holding period. If you wonder why do we have so many unmerged observations from the master data set, the master data set here is our return data set, and we did not specify here any share code or exchange code filters. We simply kept all securities in here, which would include real estate investment trust, closed-end funds, so on. And that's the reason why we have so many unmatched observations from the master data. So there's nothing to worry about here. we will focus on the ones, like I said, where we have a portfolio assignment and a holding period return. Then we exclude observations where we don't have a valid portfolio assignment. Remember, there can be stocks in our portfolio assignment data set that have a missing value on the IVol quintile. So they are part of the portfolio assignment data set. This is why they get merged equal 3, but still is a variable of interest in which idiosyncratic volatility quintiles they are can be missing. And we remove these 22,000 stock month observations. Now we need to compute a value-weighted portfolio return. And here I would like to switch orders and would like to start with how would we do that if we had an equal weighted portfolio return. Here we would say, okay, for each month, how did the average stock in an IVol quintile, first IVol quintile, second, third, fourth, fifth, perform? So for each quintile and each month, we would say, please give us the mean return across all stocks that are in this portfolio, and this will be our portfolio return. So I can run this code here, and then what you see is here we are like in month minus 401. We are in IVol quintile 1, and then what we did is we took the average of all the stocks that are in IVol quintile 1 in this specific month, and the average return in this case is 3.72%. Can do a quick check here, some return if, again, the month ID was minus 401, and our IVol quintile should also be 1. You see we have 101 stocks with valid return data in our portfolio. We can scroll down, so we see here 102 is the last observation that belongs to month minus 401 and portfolio 1. So that's 102, but there is like one stock, this one here, without valid return information. So we have 102 minus 1 gives us 101 valid return info data points, and the average return for IVol quintile 1 in month minus 401 was 3.7%, and that's exactly the number you see here. So our command here did exactly what we wanted it to do. What we then would do is we are now on the portfolio month level. We no longer need all the stock information, so we can remove that. And you still see, okay, we have 101 times, or more precisely 102 times, because we have it also for our stocks that originally had missing information. We have 102 times the same information here, which we don't need. So we say duplicates drop. Takes a moment, and now you see we have only just one observation for each quintile and each month. We can double check that to see, do we have any duplicates, in the sense that we have for one specific IVol quintile multiple observations in the same month. That's not the case. Okay, perfect. So you see here the entire return time series for portfolio 1, and if you scroll further down, at some point we are in portfolio 2, can scroll down further, 3, 4, and 5. And maybe we would like to get the data to a different format. At the moment we have also 5 portfolios below each other, and we could reshape the data also to a wide format, which is a bit easier. And then we have a pure time series data in the sense that each month shows up only once, and we have 5 portfolios in 5 different columns, so 5 variables. This captures the return for our portfolio 1, and you see here this familiar number, 3.72%. And you can see that, yeah, we get the time series data until the end of 2023. And with that, we can save our data set here. Cool. Now we are left with the value-weighted returns, and that's a bit more complicated, not super complicated. So again, what we do, we need to reopen our return data set, our portfolio assignment data set, keep only stocks that we can assign to portfolios. So that's exactly the same. Now we need to compute a value-weighted return, meaning we will weight stocks by their market capitalization. And then to get to the portfolio return, what we will do is, in the numerator, we will multiply the return with the market cap. And in the denominator, we will divide by the sum of all market caps. That gives us the value-weighted return. So we say for the numerator, for each stock at the beginning, we multiply the stock's return with its market cap. And you can think of that, what is the dollar change in value of stock I in month T. Like if you have a stock with a 1 million market cap, it has a 20% return, then what you will get here is 20% times 1 million is $200,000. So you will have a $200,000 contribution to the overall performance. And then we create an adjusted market cap variable here, just to make sure that we only take into account market caps when we have also a valid return information here. This variable here could be missing or will be missing as soon as the return is missing of a stock. And in this case, if the return is missing, the stock's contribution to overall performance is missing, then we must not take the stock into account when we compute the sum of all market caps for the denominator. And therefore, we have this command here where we say, okay, the adjusted market cap is equal to last month's market cap, but only if the stock also has a valid information for our numerator. Yeah, I forgot to run the first command. That's why I got this error here. Okay, perfect. Now, this was still on the stock level. What we now will do is we do aggregate the stock level information to the portfolio level. So for each portfolio, for each IVol quintile in each month, we take the sum of all return market caps of this variable here. And remember, return market cap is like the dollar change in value. So we add simply up all dollar value changes. And let's say that is 10 million. Then in the second step, we sum up all market cap information for a month and a portfolio. And let's say that's 1,000 million or 1 billion. Then the value-weighted return of this portfolio would be the 10 million change in value divided by the 1 billion or 1,000 million portfolio value, and then we would have 10 over 1,000 gives us a 1% return. And this is what these three commands here do. Missing just makes sure that if for all stocks in a portfolio this variable is missing, that we also get a missing value here. So run this part. Then again, first delete all the variables that we had in the computation, like return market cap adjusted, sum return market cap, sum market cap. Again, firm level information is no longer needed. If you look here, what we care about is what month is it, what is the IVol quintile, and what is the return. Like before, we now still have 102 observations here for the same information. Removes that, takes a moment, and then we can check, do we have duplicates in terms of portfolio and time? That's not the case, and that's how it should be. And then at the moment, again, we have 5 time series written below each other, one for quintile 5, one for quintile 4, and so on and so forth. So to get that in a nicer format, we again do a reshaping exercise. Perfect. With that, we have everything we need to assess the portfolio performance. And this is the last part. What are we going to do? Well, we have 2 options. We can do something for equal weighted or value weighted, and depending on which version we would like to use, we will call either the equal weighted data set or the value weighted data set that we stored. This happens here. Remember, Andrew Ng and co-authors, they compute risk-adjusted returns using the CAP-M and the Farmer-French 3-factor model. To be able to do that, we need the Farmer-French 3 factors. So what I did is I went to Ken French's webpage, where he kindly makes all this data available. I downloaded the 3-factor CSV file on the monthly frequency. It's just called Farmer-French 3 factors. I did that in September 2024. This is a CSV file originally. I put that in a Stata DTA data set and changed the returns, which are originally expressed as a percentage. So a value of 1 means a 1% return. However, here in our CRSP stock market data, we have a decimal formatting of returns, like 0.01 is a 1% return. And to make that consistent, I divided all the Farmer-French returns by 100 to make them from the percentage formatting back to the decimal formatting. Okay, and then there are some months in, for example, this data goes until July 2024. However, our CRSP data ends in 2023, so we will have some months that show up only in the Farmer-French data. I remove those and then tells data, okay, we have a time series data set and our month ID, our unit of time. And then we can compute the return difference, which is the return of our high IVol portfolio, quintile 5, minus the return of our quintile 1 portfolio. And then we can simply summarize our portfolio returns in the original Andrew Ng and co-author sample period, which is from July 1963 up to 2000. And then we can compute alphas. Here I just take this return difference and compute new West standard errors to see whether this return difference is statistically significantly different from 0. Here we are in the CAP-M, where we regress it on the market factor, and here we are in the Farmer-French 3-factor model, where we regress it on the market factor, the small minus big, and the high minus low factor. Always restricted to the original sample period, and statistical significance is determined with new West standard errors with 1 lag. Andrew Ng don't explain or don't provide information on how many lags they used, so I just assume that they used like a 1 month lag. What I do here is I use an additional package in Stata called estimation out. With this package, you can store your regression results, and then if you run all relevant regressions, you can use the estimation out command, define a name for the file you want your results to be put in, and then you can easily work with these files. It's also possible to directly export the data to a text file if you're working not with like Word but directly with LaTeX. And then for the last part, where we want to do like this out of sample test, the original sample period ends in 2000, so we repeat the same exercise, summing portfolio returns and determine the significance of our return difference in raw returns in the CAPM and the farmer-friend 3-factor model, all for the period after 2000. So let me just run this code here for you. These are like the equal weighted returns, not so interesting. These are the value weighted returns. Like I said, we have these additional months in 2024 that are not part of our data set. And here we have our portfolio returns. Remember, it's in decimals, so 0.0103 is a return of 1.03% for quintile 1, 2, 3, 4, 5. And then we can look at the result from our estimation out. We have our first test of raw returns, the second one for the CAPM, and the third one for the farmer-friend 3-factor model. It's not shown perfectly here, but what you can easily do is you can open Excel, simply copy it and put it here. Maybe just change the formatting, and then you directly have the results in a nice way. So here we see, for example, that the return difference between quintile 5 and quintile 1 amounts to 106 basis points with a t-statistic of -3.21. And this would be the CAPM of -138 basis points, t-stat of 4.68. And here we have the result in the farmer-friend 3-factor model. Okay. And here you have the results in the out of sample period. You see that observations is just number of time periods in our sample, and we are in a monthly setting. So that would be the time from July 1963 up to December 2000, and this is from January 2001 until December 2023. How close are we to the original paper? I guess it's a bit hard to see the numbers here. So what I already did for you is I put these numbers in the PowerPoint presentation. And here you have our replication results. I guess you remember this number of -106 basis points and the t-stat of -3.21 from the files that we just looked at. So just to show you that here it's just a simple copying of the information. And we can now compare our results to the results of Eng and co-authors. And we see that we get the point estimates really perfectly, or in case of the farmer-friend 3-factor model, almost perfectly. Also, statistical significance is super close. Remember, Eng and co-authors don't tell us how many legs they used, and if we would use 2, 3, or 12 legs, could be that we get even a bit closer, but I didn't want to over-engineer it here. And we can also look at the individual portfolio returns. 104 basis points, perfect. 116, perfect. 120. For quintile 4, we have a slight difference, 83 versus 87, but again, 4 basis points per month is not much. Then we have -3 versus -2 basis points. Please also note that CRSP can make changes if they find a data error. Then in a future version of their data set, it can be that they fix this error, and that might be the reason why we get here, for example, for quintile 5, quintile 4, a slightly different number in our replication. But overall, I mean, this is, I think, a great replication. It's one of the papers where you don't really have any problems in replicating the results, and the typical replication, the average replication, is usually not as close as this one here. And also, if you look at the standard deviation of portfolio returns, you also see it's like super close. So that should give additional confidence to you that you can trust my Stata code, that it performs the task as it should. It's not necessarily written in like the most elegant way, but I think it does a solid job in getting you the correct results. In terms of out of sample, if we look at the post-2000 period, we get a similar finding, I would say qualitatively similar. You see that like quintile 4 and 5 have a bit lower returns than quintiles 1 to 3. However, this difference of 29 basis points per month is of course much smaller than the difference of minus 106 basis points, and it's not statistically significant. But if you do a risk adjustment in the CAP-M or Pharma Friends 3-factor model, you get large differences of 87 and 94 basis points respectively. And remember, that's the right way to do it, because like the stocks in quintile 5 can have more systematic risks than the stocks in quintile 1. Therefore, they should yield higher returns. And as they don't, that indicates that they are like underperforming. So after risk adjustment, we still find a negative return IVol relation compared, in the cross-section of stocks. Compared to the original samples, the difference is a bit smaller. And that's perfectly in line with a paper by McLean and Pontiff, where they look at many return anomalies and they show that after the academic papers that documented these anomalies came out, that the premia of these return anomalies got smaller, being the idea that smart market participants like hedge funds started trading on them and pushing anomaly profits lower. Here you have the references. I guess most important to use the Andrew Ng and co-authors paper. Secondly is the Pharma and French 1993 paper, which was used, the 3-factor model was used to compute IVol, and we also used it to risk adjust our portfolio returns, and then the McLean Pontiff paper that I just talked about. With that, I thank you very much for watching. I think it was a quite long video, but I hope you find it helpful, and the Stata code should be so general that you could be able to simply change your characteristic, run the code. So I guess there is really a lot of opportunities to use this code if you're working with calendar time portfolios. So I hope you find it helpful. We are happy to receive your feedback, and if you have questions, feel also free to contact us. Please write to us at datacenter@safe-frankfurt.de. Thanks again for watching, and keep exploring.